We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Britton Financial Partners. This is episode number 106 of the Finances podcast. Today's guest is Andrew Paterson, partner and senior mortgage broker at Aussie Wide Financial Services. Andrew, thanks for joining us on the Finances podcast this morning, mate.
Thank you very much for having me and for the opportunity to be here.
No worries. Now, I'm not going to tell the story that I just said, but I did catch up with your business partner, Scott McDonald, yesterday at a breakfast. We've got Michelle Gertz coming in later. Did Scott tell you much about that breakfast, mate, or not?
No, he didn't actually. He mentioned he saw you there, but didn't give me too much detail.
He spent so much time networking. I'll tell you what.
I said to Amy, I said, did you see Scott? And she said, oh yeah. I said, he would have known half the people in that room. He just knows everywhere he goes.
I think you were saying just before we just hit record that Scotty likes that environment.
Yeah, he's good with an audience, yeah.
And he's certainly well respected, well known, as is Aussie Wide. Now, I wrote a little bio, a shortened a bio for you guys. Can I have a go at the bio of Aussie Wide? So, trusted name in Geelong and Bellarine Peninsula region for over 22 years. Mm-hmm. Aussie Wide's been helping homeowners secure the best loans while saving thousands on interest, fees and tax. A dedicated team rooted in the community prides itself on personalised service and expert guidance throughout the home loan process. How's that, mate?
Sounds pretty good to me.
I'll be your copywriter from now on, if that's okay.
Absolutely. I'll give you the marketing guys' details and you can redo the website.
Now, we always like to, for the first episode, any guest, we like to go back a little bit. So this podcast and stand alone when you come back on for a second and third round. Before we get into Aussie Wide and exactly what you do and some hard-hitting questions from Ben around
interest rates, what's happening.
Interest rates, we'll definitely talk about that. Yeah. Tell us a bit about yourself. Where'd you grow up? Where'd you go to school? And eventually, how did you get into sort of property finance? Tell us a bit about where it all began.
Yeah, beautiful. Thanks, Jay. Grew up in Melbourne, in the eastern suburbs of Melbourne. Sort of born and bred. Parents had lived there since the 70s. Went to school and high school in Camberwell. After school, went to university at Deakin Uni in Burwood. So very much entrenched in that inner east area. At university, sort of fell into studying commerce, which had a bit of a financial planning, finance, and a bit of commercial law major to it as well. And then out of uni, found my way into financial planning, of all things, actually. The story there was I came home from uni at lunch one day and mum and dad had their financial advisor over doing a review at the kitchen table, and we got talking and I was finishing off my degree and he offered me to come in for a bit of a trial. As we were just saying before, it was probably the worst time to enter financial planning, 2007, 2008, as the GFC was sort of really ramping up, I suppose. So did planning for a little while, mainly just in a paraplanning role, but always had that love for sort of finance and real estate. Ever since I was a young kid, most weekends there was an open house, an auction going on in the area. I would sort of go along and check out what was happening.
So you weren't doing Auskick, you were doing open homes, is that right?
Has a little mini suit on, just walking the streets.
That's what I was picturing.
Yeah, exactly. I was the penciler.
Okay.
No, not at all. But
what did your folks do?
Dad worked in television for his entire life. Started in Australia, then in London, Toronto for a little while, and then back working for the major networks in Australia.
Oh, your dad's in media and this is your first podcast. What's going on?
No wonder he's a natural.
Yeah, that's right.
It's in your blood.
Yeah, media training. No, not at all. So your dad, television producer and director for news, and mum has worked for the Victoria Police for about 40 odd years.
Yeah, what does she do there?
She's actually a librarian and researcher with the police force, so helps all the young cadets coming through with their studies.
If you was your librarian at school, you'd be thinking you're going to get in trouble, get arrested.
I look at school and uni, I definitely had the best referenced assignments, with the little table you have to do. But yeah, mum still to this day works 4 days a week for the police, and yeah, dad's retired now.
So mum's a bookworm, dad's into media, and you like property. Where did property and finance come out of all of that?
Don't know, maybe just always, as I said, love for real estate. Like I've just, numbers have always sort of been my thing. I'm not overly gifted at sports or anything like that, like happily give it a go. But yeah, just sort of always love numbers because you sort of can't really hide behind them. And real estate as well, tying, I suppose, finance and the love of property together is sort of where I've landed now. Then, yes, out of financial planning, that sort of fell apart a little bit and sharing an office space was a real estate company. So I sort of found my way into that part-time, and then that ended up being full-time. Bit of traditional real estate in the Glen Iris area, but then also a lot of project marketing. So selling, brand new properties around Australia. And obviously finance was a huge part of that. So I sort of started to enjoy the finance side more and more and more. And that's actually where I first met Scott. He was my BDM at the aggregator that I joined. Back then, he didn't really even know my name because I was very much one of the smaller operators, but we got to know each other really well through that role. And then, we had a 1-year-old when I was 31, moved down here for lifestyle reasons. Wanted to live by the beach and just get out of the hustle and bustle of the city. Commuted for about a year, back up to Melbourne, which took its toll. Then found out little son number 2 was coming along and decided, now I want to be a bit closer to home. And I actually approached Scott about setting up my own business. I was going to give it a go being a sole operator. And he he let me go through all the paperwork, all the agreements, everything I needed to do, register the trust and the company. And then the last minute said, hey, I've got an opportunity for you. And that's Aussie Wide. So that was in 2018. We took over.
Yeah, so Aussie Wide's been around for 22 years. So Aussie Wide had been in existence. What happened there? How did you both come to take on that existing business?
Yeah, so the original owner, Gary and Diane Smith, they had started the business about 25 years ago, I believe. They just got to the point of wanting to retire. They went out looking for someone to take over that they could trust to look after the business that they had built and wanted their clients to be looked after. And they were under the same aggregator, AFG, that we were. So once it sort of got known that they were looking to sell, both Scott and myself being local now, we just got introduced and started the conversation. And here we are 6 years later.
Haven't looked back.
How did you get, going back a little bit with the property stuff, did you enjoy that sales sort of side of it, or is that what you liked at the start but found maybe not like a long-term love for?
I loved it at the start, and I loved seeing all aspects of real estate. So it was new build apartments, townhouses, house and land packages, but not so much on the existing real estate side. So it was very much geared at investors. And I probably found that over time, it was a bit of a tough market back then, and sort of trying to get people into certain types of investment. And being really honest, I started to not necessarily believe in it. Like, I liked the lure of existing real estate, things that you could get in and renovate and add value that way. So I sort of probably started to gravitate a little bit more towards the finance side.
Is that an aversion to the sort of the sales pitch aspect of it, the investment, properties and development, or did you find that you were having difficulty getting people finance? I thought you wanted to jump on the other side of the fence.
Look, it was probably a little bit of both. It was a bit of an aversion to that type of property in the end. Wasn't necessarily seeing the results come for the customers. But I think it just came back to that core at university, and through school, I just sort of really enjoyed the finance side of it and the numbers. And more, I saw finance as the opportunity to really get in and help people achieve what they want to achieve. So much of everything that we do revolves around debt. So you can obviously have that negative view of debt or that positive view that it's the avenue to allow you to, do what you want to do in life. So probably I saw, my nature is to want to try and help people and achieve what they want to achieve. And I saw finance as probably the more suitable path to that.
It's very interesting, even maybe with that, because they were so investment based, what you were selling is that you sort of lose a little bit of that personal touch of people. It becomes very transactional. Like when you're helping with finance at the moment, no doubt lots of investment, but also people buying a home to live in or, upgrading their family home. And that's where, again, from our perspective, and I'm sure it's the same, you get a lot of enjoyment out of that. But when you're dealing with sort of pure investment, it's a bit more cold, a bit more brutal, probably not as much love out of it.
Absolutely. There's nowhere near as much emotion. And that's a huge part of our role, as it is with yours as well. That emotion of a first home buyer getting in and, picked up the keys of their, achieved something they didn't necessarily think was possible, and knowing that you've been part of that. Whereas, as you said, Ben, that sort of investor side, it was just numbers. And when you didn't necessarily see the numbers working out, probably pushed me away from feeling as comfortable being involved in that world and wanting to be more on the finance side.
It's interesting when you talk about the level of interest you have in client scenarios. I think that maybe the perception, maybe broking like financial planning has there's a bit of a warped perception about what we do and who we are. And I think for the majority of people, the idea of a mortgage broker is probably a very transactional experience. And I think one of the things that we've recognised in dealing with mortgage brokers and I suppose anyone, whether it be solicitors or other professionals, is that those that really excel are those that have genuine interest in the client outcome, but also have a sort of a problem-solving brain, the ones that have got a genuine interest in finding the right outcome for the clients. I know you guys specifically had some awards of recent time. Am I right in saying Regional Broker of the Year finalist 22, 24 and winner in 23?
Yep.
So what's the basis for that award? How do they work out that you're the best broker going around? Is it purely a numbers game, or is there a sort of a relationship element to that?
Yeah, definitely. Look, very honoured to be a finalist and then win that award that year. Look, it's not just numbers. Numbers obviously play a part in it. Your progression through the industry, year-on-year growth, that sort of thing. But the customer experience and satisfaction also plays a massive part in it. That sort of ties into the award that we picked up at this year's event, which was the Customer Service Award from an office. So I think the numbers, they are important, of course, and that is the metric our industry uses to sort of differentiate, well, it's the easiest metric, I should say, to differentiate how one broker performs against another. But I think the more important metric is that customer experience, because ultimately, if you're not giving a good experience to your customer, the numbers are irrelevant.
I was going to say the numbers come off the back of being, giving a good experience.
Yeah, exactly.
In the short term, maybe you get a bit of a sugar hit, but if you're not doing the right thing by people, they'll quickly go elsewhere.
Exactly.
So on the customer service side of things, what is your differentiation? What's the point of differentiation for you guys as opposed to every other broker on every other corner in Geelong?
Look, I think we're very lucky in Geelong. The broking industry is very strong down here, and everyone does a fantastic job for their clients. Look, I think our differentiation, if you have to find one, is that kind of like every broker, we just genuinely care about the outcome for the client. We all come to work every day loving what we do. And as you said before, Jay, it's about problem solving. It's about how can we start the journey with a customer, them coming in, telling us what they want to do, and then finding the outcome with as little fuss and stress and worry for that client. They just know that everything's been taken care of through our team. We have this sort of bouncing ball mentality within the team so that, the client will come in. So from that very first interaction, they're sort of bouncing their way through the whole team. They know where they're at every single point in the journey, and they're being looked after by having, the right person in the right seat. We're a big believer in, I'm a residential mortgage broker. I don't do every part of the process. We have a dedicated settlement team. We have, the dedicated support team that will work with them during an application. We have the commercial broking team. So it's about having the right person in the right seat to make sure that the customer has the best possible experience.
Was that the way it always was with Aussie Wide, or what was the evolution of that? Because again, having dealt with a lot of businesses, a lot of small businesses are trying to be everything to everyone, and that leap from being everything to everyone to actually having defined roles, it's actually not an easy jump. So what was the genesis of that for you guys at Aussie Wide?
Yeah, no, not at all. When we started, when we took over back in 2018, there was three of us. So Scott, myself, and a fellow called Ray. Ray's still with us today, runs the asset finance, equipment finance side of the team. It was a slow burn because obviously, you need to have the ability to invest back in the business and staff. So you need to be generating the business that can allow you to then invest back in the business. So it was a slow burn. The dedicated settlement team really only kicked off about a year and a half ago now. We were very lucky to pick up a lady called Lisa, who I actually coincidentally worked with back in Melbourne many, many years ago. I actually subcontracted to her for a little while and learnt, the settlement side of finance broking back then. And she lived locally and we were able to bring her over. So that allowed us to set up the settlement team. And the rest of it's just grown from slowly building the broking team as well. We've never really hired a broker that had experience. We've just hired good people that we know can engage with clients and we can teach them the ins and outs of what we do.
What's the definition of a good person?
Just someone that can build rapport with a customer is probably the biggest thing. Being a trustworthy advisor. When a client comes in, they want to know they're being given the best advice possible and pointed in the right direction. So, and they want to be able to trust in the person that they're dealing with.
I was going to say, is that a gut feel thing? Ben knows where I'm going with this, but is that a gut feel thing, or do you personality profile the people that come on board? How do you work out that they do actually have that trustworthiness and dependability?
Pretty much all of our staff and the team now actually have come from introductions from other either team members or, mutual people in the industry that we know. We've never actually advertised for a job. And in 2018, there was three of us. Now in the Geelong office here, There's 14 members of the team, and then we've got an offshore team as well. And every single person has been hired just through a mutual introduction.
I was trying to remember, I think Scott explained to me that sort of like you've got a bit of a mini program internally where people come through and then they sort of roll through. Is that correct? Again, this was a little while ago he explained it to me, but said the same thing, that no one had moved across as a broker from anywhere else. Basically, it was all sort of trained in-house, and you had a bit of a system that was obviously working.
We sort of joke it's the Aussie Wide Academy in a way. It's basically you're just, a new person. Once we sort of know what role they want to go for, whether it's a support role or a broker role, they'll just sit alongside someone else or an experienced person in that role and just be trained up for a period of months. With the brokers particularly, they obviously need to go through the diploma and training and getting the qualifications that they need. So, and they can't be doing loans in that time. So while they're going through that process of studying, they're also doing hands-on experience with a senior broker.
So as a message to anyone out there looking for roles in financial services, broking, that relationships are everything. Like if you want to prove yourself, get out and go to events like the one we did yesterday and talk to people, because we're the same. I think the majority of people in this business, we do have a few that we've recruited and advertised for, but the bulk of the people in this business have come from a personal endorsement from either a client, one of the planners, and that personal endorsement means a lot.
Absolutely. Yeah, it's the biggest insight into someone's personality and how they're going to be able to build that rapport. I think, and meeting people in their, obviously, sort of natural environment, not in a, across the boardroom table interview scenario.
Yeah, about three beers in is about the good time to get
Take them for 9 holes of golf and really see what they're like.
Ask Scott, but I'm pretty sure a few of the team have been hired either from the dog park or the pub. So,
it's definitely a good litmus test. Just on the concept of culture, you touched on that sort of grooming's probably not, it's not
careful.
We've got to be careful with that, but actually people evolving through your business, culture's a bit of a catch cry, but you mentioned in some of the sort of pre-show notes about the sort of amazing team culture. It's something that is like the holy grail for most small businesses. What is it about the Aussie Wide team that you've done to sort of develop and foster that culture that is so revered now?
Jay, I think it comes back to that point that we've hired just good people. Good people that can get along with each other. We have our little internal social club. We try to do a function sort of every couple of months where the team will catch up, either during or after work hours and do some form of activity. And I think we've sort of really built that environment where we're all just there to support each other. We've got a few team members away at the moment, but they can go away happily because they know one of the other brokers is looking after their customers just as well as they would. So it really is just that team mentality. We're all there to support each other. And I think it all just comes back to the fact that we're all just, we've just found good people that can all get along, and there's no big egos. No one's trying to outdo anyone. It's all just about we're there to support each other, because we know if we support each other, the winner is the customer.
Yeah, it's certainly important. It's a very important aspect of any small business, and I think gets lost a lot when we talk product and strategy. We have a tendency sometimes to jump straight into product and strategy without understanding that it's important to build relationships first. On that, let's talk some product strategies and what you're here to talk about, which is people's finance, lending. We wanted to ask you a few questions about sort of the state of the world. Let's go a little bit micro. The state of Geelong, Australia, in the sort of lending environment. Let's talk a little bit about sort of potentially the sort of increasing complexity of home loans, or the perceived complexity of home loans. What are some of the common misconceptions that people have when they come in to see you for finance, whether it be an investment property, their first home, a refi? Are there things that people are presenting with you at the moment that are surprising? And if so, what are they?
Look, I think probably one of the bigger ones, especially in the first home buyer market, is just feeling that they're not in a position to do something. And I think sometimes that stops people from reaching out and actually, exploring, can I get into the property market now? So probably that's the first one, actually just coming in and then we can run through, what, you are actually in a really good position. There's this government grant we can take advantage of. There's, family guarantees we can talk about. So I think it's just that old thing, you don't know what you don't know. So people feeling they're not in the right position, we can very quickly work out if they actually are. And that's one of the best feelings in this job, is when, you've had someone come in that don't think they're in a position to get into their first home, and then all of a sudden, here we are a few months later and they've made an offer and been successful in their first property. Probably the other one is how in-depth banks will go into everything. We hear this one a lot. I don't think I can get a loan because we've eaten out a little bit too much lately, and Uber Eats and, too many holidays and things like that. Obviously, understanding a client's expense is really important. We want to make sure that the bank is doing an accurate assessment, but a lot of that stuff's discretionary. And a lot of changes in the industry recently have been that lenders don't necessarily need to be, going through those statements with that fine-tooth comb like they may have a couple of years ago. They're probably the two most common ones. We don't think we can do anything, and are the lenders going to look too harshly on us?
With that point, sorry, it was on that initial point where people have, and again, it's probably through a lack of education, we talk about a lot with schools and things, is people have no idea how good or bad their household economy is. Like some people think, yeah, I'm ready to buy a house, I'm good to go. And they got $2,000 in the bank. And then someone else might have a 20% deposit, but just not have even asked the question.
Yeah.
And they're actually in the perfect spot.
Yeah,
Exactly. And they actually have no idea. And it's dangerous because you hear little bits in the media. And that's where people probably perceive, I'll never be able to buy a home. But they haven't got any structure, advice, or just a system to get themselves in that position. And we see that all the time. As we probably see it more about people think, I'm going to have to work forever because they've got no concept of what their wealth can do for them to retire. But very similar to entering the property market or upsizing or whatever that may be.
Exactly. Look, I think we sort of, not to focus just on first home buyers, but just as an example, like we sort of look at the debt as the loan, the debt at the end of it. That's just the thing that makes it possible. Buying a house and pulling all the government grants and stamp duty concessions and family assistance, that sort of stuff, that's what, we're here to help guide on and actually build this transaction for you, how you can buy a home. Ultimately, the lender that we choose is just the vehicle that makes that happen. And I think having that attitude towards debt, it's all about the home buying process. Same with investments. You want to achieve this, you've got your home, might have some equity in it. You want to get into investments, whether that's through personal names, super, trusts, whatever the structure might be. The lenders are just there to make that a possibility. So I think having that shift that we're here to help achieve the goals is sort of what probably helps, customers realize what is possible.
It probably leads into another point around, again, I think they say 40 lenders maybe on the panel that you might look at.
It seems to be a new one every day.
Yeah. And then filtering that down, again, your process, and that's your, your expertise to probably identify very quickly, okay, there's probably 10 here that might suit this scenario. I had one recently purchasing a property, and Dill helped me out, but they were, they were on income protection. So quickly you could wipe out nearly all of them, but he could funnel that down, work out the few that were suitable, and then look at those more focused. What's the general process there to work that out? Is it, again, professional judgment? You've probably got systems and processes with that as well.
Yeah, look, often it's actually easier when you have very limited lenders to choose from with a client scenario, whether it be serviceability, whether it be, personal circumstances around self-employed or whatever it might be. So sometimes it's actually a lot easier when you've only got a couple to choose from. Benefit of having a large panel. Often, sometimes the harder ones are where you can almost choose from 20 banks for a customer. So you're sort of sitting there, because we obviously can't be the ones to say you have to go with this bank. It's we give the customers choice, and our role is just to facilitate that choice. So sometimes when you've got the whole market to choose from, it's actually a little bit more challenging. It really just comes down to asking the questions. What are the requirements and objectives of the customer? Is it offset accounts? Is it redraw? Is it branch access? Is it a particular type of investment, like talking about before, Ben, with the NDIS stuff? Like, what is it within the client's requirements will help drive our decision. Then we get down to fees and rates and really picking apart the differences. We're very lucky in the industry. We've had some big advances in technology in the last sort of couple of years. Some new systems that have come in that allow us to very, very quickly put a client scenario in and then bits out the results basically of what every lender would give that client as a borrowing capacity, some ideas on current rates and things like that. So it's really about starting with what the customer needs and then sort of funneling down to the result.
All about understanding who they are, which again, same for us. If you understand who they are and what they're trying to achieve, then you can save a lot of time, because people go the wrong way. They'll just look at one bank and then they'll look at all the reasons why that won't work for them, instead of just starting fresh, understanding what they are, who they are and what they're trying to achieve, and then layering up from there.
The amount of times a customer will come in, first interaction with us, and the first thing they'll say is, I went to my bank that I have my transaction banking with and they've said, no, I can't get a loan. I'm not sure if you can help. It's like, well, yeah, that bank would never have helped you. That's just their policy. However, here's 25 that will. So it's just having that product knowledge. Again, it comes back to what you know and you don't know what you don't know.
I think one thing that has probably changed, but speaking for some of the older clients, is that they have a loyalty to their bank that the bank does not reciprocate. Whereas younger people, they're a bit more open-minded to moving to benefit themselves. But you still get the odd client who's been with their bank for 20 years and think, oh, they've always been good to me and this, that, and the other. Sometimes you've just got to be brute. Like, you've got to look after yourself. Like, they are, at the end of the day, will care to an extent.
Look, I think the CBA Dolomites program was probably one of the best marketing strategies ever.
Wow, it was a ripper, wasn't it?
The amount of customers in that sort of generation that come in, I've banked for CBA my whole life because of Dolomites.
They got their first credit card mailed to them at 18.
Yeah.
It's brilliant. Still there.
But yeah, it's, as I said, the amount of times customers will come in, current bank said no, plenty of other lenders will help out. That's what our role is, to pick that sort of apart.
I think what's a shame, and hopefully things like the podcast and you talking about this helps people that are nervous about, like we get it with investment. People say, I'm not going to go and speak to someone because I don't have enough money or I'm not ready yet. Sometimes they need someone third party to them just to say, no, you're okay, you're on the right track, or no, there is an option there for you to do it. Same with lending. I'm assuming, I shouldn't assume, but I would say that your message would be something like, come and talk to us and we'll help decide whether or not, and we'll be honest with you. And if it's not right for you, we'll actually say you're not ready yet and then give you a couple of steps to go away with and self-assess and come back to us when you are.
100%. It's all about, this is what you can do now. Does it line up with what you want to achieve? Yes or no? If it's a no, cool, let's keep in touch. And as things change through that customer's, personal circumstances, we'll just keep reassessing. We were talking just before about the stage 3 tax cuts that just came in. We had customers 1 month ago that couldn't quite get the loan amount they need, whereas now they can. Nothing's changed in their circumstances. It's just simply that they've got slightly higher net income from the tax cuts, so now the lender will give them the loan they need. So I think it's always just about checking in, understanding where you are and where you want to get to. And a good broker's role, just like a good planner, is laying out those steps to give the customer optimism as well. The amount of times we have people come in saying, oh, I went to see a broker previously. They told me I was no chance, couldn't buy a house. And here we are, a few months later, you've helped us get a property because you helped us put some steps in place. And whether that's, a real common one at the moment that we're seeing a lot of is with the indexation changes to HEX. Can we maybe consider closing the HEX debt down to give us better capacity? It helps the customer two ways. One, higher capacity. Two, gives them more net cash flow into their each pay cycle. Simple little things like that. If you're looking for the solution, you can generally find it.
I think that's a massive thing I get annoyed about, where people don't give people the next step. Maybe not right now, can you do this? But if you do 1, 2, 3 things, give them something to aim for. Otherwise, they just get them a negative experience. They don't do anything to improve it. And in 2 years' time, they'll come back and they'll have the same conversation, and then they'll start to do those 3 things. So it's not right now. Often we have that with clients. We go, right, here's a couple of things over the next 6 months, 12 months. We'll touch base and make sure you're doing them. But that will be the trigger for you to be able to do that more significant goal.
100%.
Yeah, you're setting a foundation for them, which if they don't come and speak to us, that foundation doesn't exist. One of the things that was in the original bio, you talked about interest, fees and tax. I was thinking about that in terms of how much value clients actually place upon the value that you can add around just giving them sort of a product at the end of the day. I was thinking about tax. So talk to me a little bit about from a tax planning point of view. How does tax planning, most people when they're thinking about restructuring their debt, it's probably not the first thing that comes to mind when they're thinking tax, unless they're very well versed in sort of investments. But on the tax side of stuff, what are you doing to actually improve people's tax position with their lending and refinances?
Yeah, look, obviously we need to be very careful. We're not tax advisors, we're not accountants. So
That was a trick question.
I was going to say, I thought you were trying to trick me up.
Compliance done. So we generally have very good relationships with customers, accountants and planners, so that we all work together to achieve that goal. With the tax side of things, it's probably just understanding, having the right structure from the start. If a customer's long-term goals over the next 5, 10, 15 years is to build an investment portfolio, well, we want to make sure that we don't possibly get the debts the wrong way around at the start. We don't want to, have the owner-occ highly geared and have the first investment property lowly geared, because, then when we try to get the tax deduction benefits, or the accountant does, I should say, it's hard to sort of unwind that, because it all comes back to the purpose of your lending and that sort of thing. So I think it's just understanding the long-term goals and setting the right structures in place, but following the instructions of the accountant and the planner to achieve that for the customer. And then from our point of view, We have a look at with borrowing capacities and things like that. The negative gearing benefits are taken into consideration as well. And then, looking at, what sort of vehicles properties might be purchased in. So are we doing it in personal names? Are you now looking at super versus trusts and companies and the pros and cons of that? Again, never giving the advice because we can't, but just working with the trusted advisors to set that up correctly.
And more than ever, it's a team game, that isn't it?
I was going to say, I hope everyone that's listening to this listens to what you just said. And it wasn't a trick question, but I was interested in just that the collaborative approach of what are the intersecting circles, what do they call it? A Venn diagram of you got your accountant, your financial planner, your mortgage broker, your solicitor with overlapping elements in the middle. I think to me, that is where you get the best value, where clients get the best value because you end up with the right product at the end of the day and the money to do what you want to do, but structures, tax considerations, but not only now. And that, back to your mode of operating and thinking about the future and problem solving, it's so important. A lot of the value is deferred value too. It's like deferred reward that if you ignore, you potentially set the client up for failure or a negative consequence at some point down the track. And I think that, to me, back to what differentiates Aussie Wide from other brokers, and you were very gracious in not shit-canning any other brokers, which is just lovely, but it does make a massive difference. Like, it's a huge point of differentiation when you have that collaborative approach and you do problem solve your way and care about what the outcome for the client's going to be, not only when they get the money, but what happens in 12 months, 5 years, 10 years. And that also doesn't come overnight. No. Like, that comes with experience. That's because you came from a financial planning background, that you come from our world, that you've got that head on your shoulders. It's brilliant.
You see a lot of time where people have rushed that process, and then when they get caught up big time later on. I think about where they've crossed loans over, which is probably like, and you almost every time you see that, it's been either done directly with a bank or maybe a broker who's just rushed it and just wanted to get the purchase done. And sometimes I think we have to have hard conversations with clients to say, look, this is going to take longer. We need to wait for something else to get this in the correct order, because otherwise you're going to have a mess later on and you're going to sell a property and end up having no proceeds in your pocket that you were banking on. Again, you would have seen that. I see it every now and then, so I'm sure you see it all the time.
Hit the nail on the head there, Ben. That's probably the biggest one, is when a customer traditionally has maybe gone to a branch directly and just things were set up in probably not as much of a future view. Cross-securing is probably the biggest one, where, the owner-occ and one or two investments have all just been tied together. The strategy of the goal of the customer might be to sell the owner-occ and upgrade, or sell one of the investments, and then trying to pull all that apart. As you said, they're banking on certain proceeds to come through, and the lender turns around and says, oh no, you need to pay that debt down instead. And all of a sudden, the whole thing's a mess. And the amount of times you say to the customers, oh, you've got 3 loans here, 3 properties, are they crossed? And then I have no idea. So there was no sort of consideration to the future in the way it was all set up. And as you say, you get it right to start with. It just makes multiplying that so much easier.
And I think with that, I've said to a few people, it's okay that you've done that as long as we know. But often people, they just didn't even know.
Yeah.
Because it wasn't explained to them. They went to the bank and said, we need 450, and they said, yeah, no worries, we'll just do this. They stopped listening once they said yes.
Yeah.
So then they have no idea what they've actually got. All they know is that they got the money, they got what they wanted, and then they move on, and then they find out the hard way.
Exactly.
5, 10, 15 years later.
Yeah.
Can I take us off on a little tangent? You mentioned a couple of things about technology and sort of how it plays into your organisation and makes things easier. You mentioned some technology that you're using at the moment. What roles tech played in your operations and the efficiencies that you've spoken about already?
Yeah, look, we always, when we took over Aussie Wide and set that up, we had the goal to be a paperless office, and I think as a lot of businesses do these days, modern businesses. So that was a relatively straightforward one. But then the banks were still very manual, even up until a couple of years ago. COVID was bad as it was for a lot of reasons. It was actually the catalyst to a lot of change in our industry. So pre-COVID, loan application forms, loan offer documents, mortgages, everything was all paper-based. So we were trying to be a paperless office, but you still had to print everything, collect it, sign it, scan it. Fast forward to obviously a time in life when we couldn't see customers as easily. It advanced, your online interview technology, so Zoom, Teams, those sorts of things. They're now recognised as a proper way of verifying identity of your customers. You can do that digitally now. lenders all moved to online or e-sign application forms, which was a big start. And now it's all moved to e-sign loan offer documents as well. So, there's Victorian titles, mortgages can now be done electronically. They used to have a witness requirement, which meant they couldn't. So that's been a big change. The other thing that it's probably done is put so much speed back in the market. So perfect example, we had a file yesterday that had to be reworked in the morning for settlement yesterday. New loan offer, it was approved, loan offer documents out, back, signed, returned. It settled at 4 o'clock yesterday, Arvo. And that's from getting reapproved at 11 a.m. That did not exist 5 years ago. It was people were rushing into the city to swap checks over in, Collins Street at the titles office. So yeah, tech, the advancements have mainly come from the lenders, and then we found sort of our third-party tech providers like that system I mentioned have sort of come in on the back of that.
What about data collection for clients? So when you're collecting reams of data, the stuff that maybe historically the clients had to bring to you, how do you go about collecting all of that now?
Yeah, so I suppose the important thing there is to understand that every customer can be a little bit different. We still absolutely have the customers that want to bring things in and could go to the bank, print off the statements, bring them in. That's fine. Of course, we can work with that. But mostly it's through a portal system. So an email link goes out. It's all two-factor authenticated and all nice and safe. And you can just upload everything, anything bank statement related. So transaction accounts, savings accounts, existing home loan statements, that's all collected through a third-party provider, bankstatements.com, or Ilian's the other name. And again, that provides great insight for us because it doesn't just give us the statements we need with a click of a button, but it also categorizes all those expense categories that we were talking about as well. So we can get a really good view of a customer's situation to ensure that, the lending products that we're recommending and putting them into are not unsuitable. So yeah, pretty much for most customers, everything is digital now. So
how much has it actually improved the turnaround time? So if you had from when you began to today, what sort of turnaround time difference is there from 5 years ago?
Look, massive change from the old days where you had to get a fact find sort of, they'd print it out, fill it in, scan it back. We'd have to then manually enter that data ourselves and then start looking for options. Because everything is now online, our fact find forms are done through that portal, which links straight into our CRM software, which links straight into the bank's software. So we could theoretically meet a customer in the morning and be applying for their loan at lunchtime if they could get us all the info. And if we were to go to a lender that had fast turnaround times, you could possibly be approved that afternoon. And that's just because the lenders have had massive leap forwards, as have, businesses like ourselves in this speed and ability that we can not just collect the data that we need, and there is a lot of data. That's probably one of the biggest things we get is, do I have to provide all of this? But we're not asking for it for fun. The bank needs to know that. But if we can enter all of that info quickly and accurately, then it just leads to such a better outcome for the customer.
So what's the next tech evolution in finance?
Look, this talk, the AI word comes in where, talking about AI finding the right lender for a customer. I'm not sure how that would go. I mean, I'm certainly not a tech whiz, but there is still so much personal advice and guidance in the industry. So I kind of feel tech's at its best point now. We've got all these solutions that are nice and quick and efficient and fast, and then you can link those systems and solutions with good advice, I suppose.
So you're saying you're a Luddite. Is that what you're saying?
Yes.
Yes. It's funny, thinking about AI as a tool, like most things, it can be used poorly, it can be used well. But in our world, I think, which is very similar to your world, if it does anything, it actually frees us up to spend more time with clients. It frees us up to actually spend more time doing the personal relationship, the problem solving one-on-one with people. I think if used well, it should allow the people that are good with relationships and good with connecting with people and good with problem solving to do it even better. So again, I've been sort of cautiously optimistic with tech. Obviously, there's obviously massive security potential for it to go wrong if it does go wrong. But I think if we're cautiously optimistic, then the future should be bright. Is that right, Ben?
Just waiting for you to do a little AI plug.
No AI plug here today. Now, I'm mindful of time. I might look at the rapid fire questions. They don't have to be rapid fire responses, but a couple of things I wanted to touch on. One of them was like for people looking to invest in property for the first time, what sort of strategies or tips would you give to people looking to invest in property for the first time? Maybe sort of top 5 tips for people looking to get into property for the very first time?
Well, number one, probably understanding where they sit. So to make any transaction successful, whether it's buying investment, buying owner-occ, we need to have the combination of equity or deposit and capacity. And then the other one I throw in there is policy, the sort of little three pillars of lending. Policy one's up to us. We sort of make sure we navigate that one. But, you know, if a customer's looking to invest for the first time, the power of equity cannot be under sort of considered. So coming in, understanding the value in their current property, and then we can clearly show strategies of how easily we can pull out that equity. And when we talk about that, we're sort of generally, because we're trying to avoid cross-securing most times, pulling out, you know, a 20% plus costs deposit from the existing property, and then having a approval for standalone purchase at sort of an 80% lend to avoid extra fees and mortgage insurance on the purchase. As I said earlier, you know, the serviceability for an investment property is actually improved because we can use the proposed rental income. We can use the negative gearing benefits from that tax deductible debt. So generally, for people wanting to invest, as long as they're on good incomes and they're quite comfortably servicing the debt that they have now, as long as they've got equity, they could be ready to go now. And that's probably back to that earlier point of people just not necessarily knowing or having the confidence to explore where they're at. So tip one would probably be just come and find out where you're at. You know, do we have enough equity to start that process?
I think the cash flow side is the part that people, sometimes they understand the equity or they have good cash flow or they think they do. But having both of those things together is probably the part that people not as often have going for them. And then, they have equity, but they're just servicing the debt they've got. Well, if they're going to go and add in an investment loan, $600,000 more debt, it's going to be negatively geared from a tax and cash flow position at the moment.
Yeah.
How will that impact their day-to-day? Will they actually still be able to afford to live the life that they want to? Or will they feel great? Or we've got an investment property, but no more going out for dinner.
Yeah, exactly. Look, I think there's the difference there between what the lender would let you have in terms of capacity and, they'll throw that loan amount at you, but also tying that in with what the customer is happy to take on. Exactly to your point, Ben. You never want to, just because the bank says you can have $1 million loan, that's fine, but you might only feel comfortable with a $500,000 loan because we obviously work out what the repayments will be and we can help with budgeting and putting that into their cash flow and making sure that it's not going to get them into strife.
I suppose you look at that now, the people who borrowed max over the last decade, and now the rates probably tripled for them. Now they're stuck.
Yeah, absolutely. Well, going back, APRA, the regulator, have the assessment rate buffer sort of cap on lending, I suppose, where the actual interest rate generally has a 3% buffer put on top of it, and the lenders assess their ability to repay at that higher rate. So for a standard owner-occupier at the moment, that might be assessed at 9.1, 9.2%. If we go back 3 years ago, actual rates for investment was, 3.5%, something like that. Those actual rates now are sort of 6.5%, but the assessment rate back then was 6.5%. So it is kind of the first time in our history with this regulation from APRA where the assessment rate is being tested. Unfortunately, we are seeing, you do see people that did go to the max and now feeling it a bit and you're having to offload those investments. But I think that's the important thing as well for now is that lending should be considered quite safe. Assessment rates at 9.5%. If interest rates get to 9.5%, you guys are probably better at understanding the impacts of that than me, but I just can't see obviously that happening. So anyone borrowing now should hopefully be a bit more confident that it's not going to be stretching them too far.
You talk about the interest rate trends and how people are dealing with that at the moment. What you seeing any other common themes or trends in the market with loans at the moment that people should be aware of?
Fixed rates are probably the one that comes to mind. So obviously there's a lot of talk about what's going to happen with variable rates, and I wish we had that crystal ball and when we knew, and the rate cuts seem to keep getting pushed out in terms of when they're expected to come through. But fixed rates for me are probably the good indicator at the moment. So if you look at an average owner-occ variable rate is around your sort of 6.1, 6.2. We have fixed rates now coming in the high fives for say 2 years fixed rate. So lenders, in my opinion, in the game of losing money. So if they're offering fixed rates lower than the current variable, to me that does give a bit of optimism that the variables will be down if at the same level or possibly, hopefully, a bit lower than that within that period. That's probably the biggest trend that we're seeing. Investment rates have come down quite a bit. There's some lenders with some very attractive investment rates out there at the moment. Some of these investment rates are lower than the owner-occupied rates from more of the major banks. So we haven't seen much movement in the variables. Lender specials come out all the time. They call them under the table offers, certain loan amounts above a certain rate with depending on the loan to value ratio, they might give you an extra 10 or 15 basis points off the rate. They're not publicly advertised. So there's not a lot of movement in the variable market, but it's probably the fixed market that I look at the most at the moment.
Are you finding people seeing those fixed rates lower are eager to jump in and fix their rates? Like, is that something that people are trying to do and need to be cautious about that?
Yeah, the conversations definitely started happening again. We probably haven't had the fixed rate conversation really for the last 2 years because the fixed rates have been so much higher than the variables. But now that they're starting to come down a bit, absolutely, we're seeing customers ask that question, should I consider fixing? And it's not necessarily to try and beat the bank. It's more just about cash flow and budgeting.
I was going to say, what's your personal thoughts on fixed rates?
It depends on the circumstances, really. Like, if you want that absolute certainty and you don't want to be sitting there stressing about what the Reserve Bank and then the lenders are going to do each month, then fixing is a great option because it just means that for the next 1, 2, 3 years, however long you fix for, you can just sit back and not worry about it. If that repayment amount is comfortable for you, then just focus on getting that paid. So I think it comes down to the scenario of the customer, really.
The important part of that is noting that it does depend.
Yeah.
And I think the important part of having a relationship with someone that you can actually talk through the scenarios with is that you help them rationalise which is actually going to be best for them. They'll make the decision, but if you give them the information to be able to make an informed decision themselves, they walk away going, okay, this suits me.
Yeah.
In my circumstances, this is what actually suits me. And I think that is much better than trying to compare or beat the bank or look at what your next door neighbour's rate was. What's suitable for your own economy, your household.
Yeah.
That's the most important thing.
The other side of that, and this is probably reflecting on what we've seen over the last decade, is it doesn't have to be all or nothing on that too. Like so many clients we had, fixing 50, go fixed 50, variable 50, just sit on the fence, have some certainty, have some ability to still see your rates come down, all those sorts of options that are out there. A lot of people just think, oh, it's all or nothing. Got to fix the whole thing or I don't fix any of it.
Yep.
There's so many hybrids.
Absolutely. Split loans is the term there. And exactly as you said, Ben, there's no guideline on that. You could have 50-50, you could have 90-10, whatever ratio you want of variable, fixed. If it's investment, it can be principal and interest repayments, interest only. Like these are all the sorts of things that you can, build within that scenario for a customer.
I think for the uninitiated, that's really important for them to hear as well, that we think, I want to go and get a loan. So I just get a loan. The structure of the loan, again, the importance of actually going and speaking with someone cannot be oversold. We should be talking about it all the time. If you've got an issue or if you're thinking about lending, you need to go and speak to someone who knows their shit and can talk to you about structure and time frame and cash flow and your economy, your household economy, because that's what's actually going to get you the best result. You just go and try and wing it yourself, you'll inevitably come up with some pain points. I've got one last question, unless Ben's got some more, and this one's a bit of a vested interest on the financial side of things, just inquisitive about how you think about this, but what's the best piece of financial advice you've ever been given, and did you implement it?
Probably for me, it's debt is not bad. It's don't be afraid of debt and use it to your advantage. So, if you're scared of taking on debt, then it's very hard to build wealth. If you're happy to take on debt and in the right way, not being rushed about it and not extending yourself too far, then it can really work for you. You can have an investment property that close to pays for itself, depending on the rental yields, and then you sit back and pick up the capital growth. Using debt to get into the equity markets, investing in funds, superannuation investments, things like that. Yeah, debt can be a really good tool to help advance where you want to get to if used wisely. And probably,
I think it's a massive thing because people have a very warped perception of debt as just evil.
I think it's a generational thing. There's a generational aversion to, and you think about our parents or my parents, the focus, and Peter was a little bit different, but Mum, conservative, it was, listen, we get debt only because we have to, and it's gone. Like we're just getting rid of it. And as soon as I can get that title back, I'm relieved and the pressure's off, rather than, I suppose, and it's a little bit like investing too, that the concept of risk that people set aside the decision to invest or the decision to lend. If you can get some support, you can get some advice, you can get some counsel around those things. And back to Dolomites and kids and education, there's a generation of kids now that we should be educating better around the ability to invest, the benefit of investing periodically over a long period of time, and also not to be afraid of debt, not to be afraid of debt, that you can actually use it to leverage your wealth. And to be honest, you're probably going to need to. Like, as we move through the next few decades, you're probably going to need to do that. You're going to need to take some educated and counselled risk to be able to grow your wealth.
I think the two sides of that is debt on the way up as you increase it. But what the other gap is that the people that don't have a clear plan on how to get rid of it. Like, I think you need debt. It's essential to build the wealth, but you've also got to understand that point in time where debt needs to start to be relieved. So whether that's through sale of a property, especially we see around that sort of pivot point as people start to approach retirement, is often they need to look at ways to get rid of a debt. And that can be a chunky transaction like a sale of a property or realization of another asset. So the process of knowing what you've got and building debt progressively, but then also knowing you can, on your own terms, pay that back down again. Because I don't think, again, I'm sure it has happened, but there's not very often people in retirement are served well by having too much debt. It's very, very rare that that's a preferred outcome.
Oh, 100%. I think, we have some very basic calculators. You could easily search an extra repayment calculator anywhere. Our website has some great resources, but, showing a customer your minimum payment is this, but if you can afford to put an extra $50, $100 a week, a month, fortnight, whatever it is, over the term of that loan, how quickly you can pay that debt off, and also how much interest you can save on that debt simply by just making these little extra tweaks here and there. I think that is the role of a good mortgage broker. It's not just get someone a loan and say goodbye. Yeah, again, the loan is the vehicle to make this possible. Now let's come up with strategies to get that paid off as quick as possible if it is the owner occupied. Use that investment debt to give us those tax savings and whatever it might be to help pay off that owner occupied even faster. And just back to the point earlier about, debt is not something to be afraid of. Certain debts are. So short-term debts, your afterpays, your zip pays, basically debts that sort of suggest possibly living a little bit beyond means. They're debts that we obviously want to try and avoid and clear up where possible, taking on huge car loans instead of looking at property and stuff like that. That's sort of where maybe we've got to have that right attitude towards debt. But yeah, as a whole, it's just, I suppose, understanding what debt is and using it to your advantage.
Beautiful. I think that's probably a nice place to wrap it up. Andrew, before we do wrap up, you mentioned some of the calculators on the website. Let's talk about where people can find those calculators and where they can get a hold of Scott, yourself and the team at Aussie Wide.
Yeah, beautiful. So the office is in Moorabool Street, 255 Moorabool, just up near Myers Street there. Anyone's always welcome to pop in. Website, aussiewidefs.com.au. Has some amazing resources on there. We've spent a lot of time building out the resources tab there. And it's all completely free and no obligation and easy to use. And then just the usual socials, Insta and Facebook.
At Aussie Wide on all of those, is that right?
At Aussie Wide, yes. Slowly building that up. It hasn't been our focus for a few years, but starting to get there. The website's been the main.
You made it to our Instagram on the golf day, so that's all that matters.
I was going to say, if you're looking for Scott, probably in the first hole at Barwon Heads, probably be where you'd find him most of the time. So
it is Friday, so yeah.
Andrew, thanks again. Appreciate the time. We look forward to a round 2, and thanks for everything that you do for us and our clients, and also the clients that you have with Aussie Wide. Thanks again.
No, thank you so much for having me. Absolute pleasure.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.